Special provision for computing profit and gains of business or operation aircraft in the case of non-resident Section 44 BBE. Section 44 BBE is a non-abstinence clause. According to Section 28 to 43, is not applicable in the case of non-resident engaged in business of operating aircraft. Not applicable in the case. 28 to 43 is not applicable. Eligible associate Section 44 BBE provides presumptive rate in the case of non-resident engaged in the business of operating aircraft. Presumption tax. Income from such business is calculated at the flat rate of 5% of the following. Amount paid or payable in or out of India to the tax paid or to any person on behalf of the account of a passage or carriage or passage livestock mail goods for the place in India. Amount received or deemed to be received in India by on behalf of the taxpayer on account of carriage of passengers, livestock, mail goods and other parts outside India. Mr. Q, a non-resident, operates aircraft in Singapore and China. He received the following amount pay carry out the business operation of aircraft in 2 crores in India account to carriage a passenger from Chennai, 1 crore in India account to carriage from Chennai, 3 crores in India account to carriage of passenger from Singapore, 1 crore Singapore account to carry passenger from Chennai. In Singapore account from Singapore 3. In India, accounts of carriage passenger from Singapore. So 3 crores. Total expenditure incurred by Q purpose of the business during the India 6.75 crores. Compute the income of Mr. Q chargeable to tax in respect of profit and gains of the business profession. Assessment 24-25. What would be the answer in case of business carried out in the foreign company and Q answer? Solution 44 ABBA says that the computation of the profit and gains of the business operating aircraft and non-resident sum equals to 5% of the aggregate of the following. Paid or payable whether in or out of the India and with assessee or to any other person on behalf of the carriage of passenger, carriage of light goods, carriage of maize, carriage of goods in any other place of India. Received and deemed to be received in India on the behalf of the assessee on account of carriage of passenger, livestock, mails, goods and other places of India. Keeping the view of the provision 44 BBA, the income of Q chargeable to tax in India, profit and gains of business and profession works and done. Amount received in India carriage of passenger from Chennai 2 crores. Amount received in India on account of carriage from Chennai 1 crores. Total 7 crores. So the income from the business under the 44 BBA is 5% of 7 crores, 35 lakhs, which is the income of Q chargeable to the tax in India under the profit and gains of business or profession 44 24. Upon assessment at 24, 25. In the case assessees of foreign companies, SK are limited, the answer should be same since 44 BBA does not distinguish incorporate or non-corporate buyers who operates aircraft provided this residential status of the non-resident. Special provision for computing profit and gains of the foreign companies engaged in the business of civil aviation that is certainly turnkey power projects. 44 BBA. Eligible as a foreign company engaged in the business of civil construction or the business of aeration of plants, machineries and testing or commissioning, therefore in connection with the turnkey power project approved by the central government in behalf. Presumptive rate. The sum equal to 10% of the amount payable or paid, whether in or out of India, to the said assessee or to any person on behalf of the account of such civil construction, erection, testing, and commissioning shall be deemed to be the profit of the gains of the business chargeable to tax under the head profit and gain of the business profession. Option to claim low profit. Assessee may claim lower income than presumption rate of 10% if he keeps maintaining the books of account under the section 44A and 2 and gets auditor a furnished report of section audit under section 44A. Assessee in all the cases shall be done in the assessing officer under section 143. No set off or unobserved depreciation and brought forward loss. When assessees declare the profit and gains at 10% of the previous year in accordance with the presumption provision under the clause and unobserved depreciation and brought forward loss would be allowed to assessee for such previous year. No summary of the presumptive provision applicable to non-resident. Nature of business, eligible assessee, presumptive income, and specified sum. Option to declare lower profits. Okay, here shipping business, is not eligible for non-resident and present with 7.5% of specific sum amount paid or payable on account of carriage of passenger, carriage of livestock, carriage of mail, or carriage of goods and ships and any ports from the India, and amount received or deemed to be received in India on account of carriage of passenger, livestock, mail, or goods shipped from any of the port in India. Option 3 for no profit, no. But in the case of 44 BBE, operation of aircraft, same thing, 5% or non-percent. But in the 44BB, as persons of providing service or facilitation connection with the supply of plant and machinery and higher use or be used in the perspective of extraction or production of mineral oil, non-resident. Presumptive rate is 10% of specific term. Amount paid or payable on account of the provision of such services and facility for the aforesaid profession of India. Amount received or deemed to be received in India on account of the provision, service or facility for the aforesaid purpose outside India. 44 BBB, business of civil construction or the business of erection of plant and machinery or testing of commission. Therefore, in connection with the Turkey power plant project approved by the central government, only foreign companies are allowed, and it is 10% specific sum amount paid or payable on account of such civil construction, erection, testing, and commission. A lower profit may be claimed under Section 44 BB. Under Section 44 BBB, provided the assessee maintain books of accounts under Section 44 AA and gets the monitor under Section 44 AB, and no set off or unobserved depreciation or brought forward loss would be allowed to the assessee in the previous year in which it has declared profit and gain a 10% in accordance with the presumption of provision like 44 BB and 44 BBB. Deduction in respect of head office expenses in case of the non-resident 44C. In the case of non-resident, head office expenditure is allowed in accordance with the provision of 44C. The section of non-abstinence provision and anything contrary contained section of 28 to 48 is not applicable. The section non-abstinence provision and anything contrary contained section of 28 to 43 is not applicable. Deduction in respect of such office expenditure restraining the lease of the following levy. The deduction respect of the head office expenditure interests are restricted to the least of the following. The amount equal to 5% of adjusted total income, or in the case of loss, 5% of the average adjusted total income. The amount so much of the expenditure, the nature of the head office expenditure is incurred by assessee as it attributed to the business or profession of assessee in India. Meaning of the term adjusted total income, average adjusted total income. So adjusted total income. Total income computed in accordance with the provision of the Act without giving effect of the following. Allowance under the section, unobserved depreciation, allowance under section 32, class 2. Expenditure incurred by a company for a purpose of promoting family planning amounts employed under section 1 provision to section 36(1)(9). Business law brought forward section 72(1), speculative laws brought forward section 73(2), laws under the capital gain under section 74(1), laws under certain specific source brought forward under section 74(a)(3), deduction under section chapter 6A. Average adjusted total income. The total income assessee assessed on each of the 3 assessment years immediately preceding their relevant assessment year. 1/3 of the aggregate amount of the adjusted total income in respect of the previous year relevant to the aforesaid 3 assessment years average adjusted total income. When the total income of the assessee is assessed only for 2 aforesaid 3 assessment year, 1/2 of the aggregated amount of assessed total income in respect of the previous year relevant to the aforesaid 2 assessment years taken as average adjusted total income. When the total income assessee is assessable only for 1 aforesaid 3 assessment year, the amount of adjusted total income in respect of the previous year relevant to the assessment year's average assessment total year. Head office expenditure. The executive and general administration expenditure incurred by the assessee outside India, including expenditure incurred in respect of rent, tax, rates, repairs, insurance, or any other purposes outside India used for the purpose of business or profession. Salary, wages, annuity, pension, fees, bonus, commission, gratuity, perquisites, or profit in lieu of or in additional salary, or where paid or allowed to any employee or other employee employed in or managing the affairs of an office outside India. Traveling by the employee or other person employed in or managing the affairs of any of the office outside India, such as a matter connected with the executive general administration as may be prescribed. Deduction of head office expenses in the case of non-resident while computing the profit and gain from the business profession. lower of 5% of the adjusted total income or amount of head office expenditure incurred by the non-resident attributed to the business or profession in India, meaning adjusted total income, the total income without giving effect of head office expenses, unobserved depreciation, capital expenditure on family planning, losses carry forward, that is brought forward loss of section 72, speculative business loan section 73 to long-term capital gain, short-term capital gain loss under section 74, subsection class 1, losses for owning and maintaining resources 74A3, deduction under the chapter 6A from GT, gross total income. Meaning of head office expenditure. The executive and managing general information expenditure incurred by the non-resident outside India, including rates, rent rates, taxes, repairs, insurance, any other purposes outside India used for the business and profession, and salary, wages, perquisites to any of the employees or another person managing the affairs of outside India, traveling expenditure to any employee or other employee managing affairs of the home office outside India, such as the executive or managing internal administrative expenditure prescribed. Illustration 9. The net result of the business carried out on the branch of head of foreign company in India for the year 31st March 24 was a loss of 100 lakhs after charging head office expense of 200 lakhs allocated to the branch. The explained reason of the income to be declared in the branch of the return assessment year 24. Under section 44G, restrict the allowable head office expenses to the extent of lower of 5% of the adjusted total income or the amount actually incurred attributable to the business of the associate income, whichever is lower. For the context of computing the adjusted total income, the head office expenses of 200 lakhs charged to the profit and loss to be added back. The amount of income to be declared under the is 100 lakhs. The head office expenses of 100 lakhs is 5 lakhs or 200 lakhs, whichever is lower, 5 lakhs. Income to be declared in the return is 95 lakhs profit. Special provision for computation of the income by way of royalty, etc. in the case of non-resident section 44TA. Eligibility. Section 44TA provides a method of computation of income by way of royalties or fees for technical surveys received from a marriage agreement made by the non-resident with the income Indian company or government of India after 31st March 2023. Whereas a non-resident carries a business or profession in India through the permanent establishment of fixed place of profession. The right property contract in such a way that royalty or fees of technical service are paid and effectively connected with such permanent establishment of fixed place of services. Expenses are not allowed as deduction. While computing the income chargeable to tax under the section, the following expenses are not allowed in the section. The expenditure and allowance incurred by not wholly or exclusively for the permanent establishment of fixed place of service in India. Amount paid otherwise or reimbursed for the actual expense by the permanent establishment to head office or to any of this office. Non-applicable to section 44B. The provision on 44B does not apply with respect of income covered by the section. Mandate is required to maintain books of accounts and get them audited. Under the section, non-residents are mandatorily required to keep and maintain the books of accounts in 44A and them audited before 1 month prior to the due date of furnishing a return under section 139(1) and furnish the date of report of the audit. As in the case of due date of filing the return under section 131, specify date of tax audit. In the case of assessee who is required to furnish audit under section 92E, 30th November and the assessment year, specific date of tax audit 31st October and the assessment year. In the case of other assessing included under 4480, 31st October and the specific date of the audit date is 30th September. Capital gain taxation for non-resident. Any person, including a foreign company or a non-corporate non-resident, liable to capital gain tax in India if there is a transfer of property, a capital asset in India which result in profit or gain. The provision relating to non-resident inter alia respective of the capital gain taxation discussed in detail, Chapter 4. First provision of Section 48 reads to Section 115A. In the case of non-resident who invest foreign exchange to acquire capital asset exchange rate fluctuation benefit allowed while computing the capital gain arising from the transfer of the shares, debentures of the Indian company as the first provision Section 148. Capital gain taxation for non-resident. Any person, including a foreign company or non-corporate non-resident, is liable to corporate tax. Corporate tax in India. If there is a transfer of property in India as a result of profit and gain, the provision related to non-resident capital gain taxation discussed in Chapter 4 capital gain model. First provision 48 read with 155A. In the case of non-resident who invest foreign exchange to acquire capital assets, the exchange rate of fluctuation benefit is allowed while computation. Non-resident invest in foreign exchange to acquire the capital asset. Exchange rate fluctuation benefit is allowed when computing the capital gain arising from the transfer of shares and debenture in India as per the first provision of section 48. The same to be computed in the following manner. The cost of acquisition, the expenditure incurred wholly exclusively in connection with the transfer, and full value of consideration has to be converted into foreign currency and which such shares or debentures are acquired. The result of capital gain shall be converted into Indian currency. The opposite mention of computation of capital gain shall also apply for every purchase and sale or debentures in Indian company. Benefit of indexation is not applicable in this case. Section 115BA, the income tax rule 1962 provides the average of a telegraphic transfer buying rate and telegraphic transfer selling rate for a foreign currency initially utilized for purchasing of capital asset and the date of column of column 3 below it, but should be converted into rupees in the foreign currency for the purpose of computation of capital gain. Items, SL number, date. Date of acquisition of capital asset, date of acquisition of capital asset. Cost of acquisition of capital asset, date. Date of acquisition of capital asset. Expenditure income wholly incurred in the connection with the transfer of capital asset, date of transfer of capital asset. Full value consideration received in acquisition of the result of transfer of capital asset, date of transfer of capital asset. For recovering the capital gain computed in the foreign currency initially utilized in the purchase for capital in rupees, telegraphic transfer buying rate of such currency as the date of transfer of assets to be considered. The meaning of telegraphic transfer and buying rate. The rate or the rates of the exchange adopted by the SBI, State Bank of India, for buying the foreign exchange, having regard to the guidelines specified by time to time by the RBI for buying exchange rate where such currency made available to the bank. Telegraphic transfer. Telegraphic transfer selling rate. The rate of exchange adopted by the State Bank of India for selling foreign exchange where such currency is made available by the banks for telegraphic transfer. However, the benefit of indexation and currency fluctuation would not be available in respect of capital gain arising from the transfer of following long-term capital gain referred to section 112A. 112A, it is long-term capital gain, right? Short-term capital gain. The equity shares of the companies, the short-term capital gain is paid for both at the time of acquisition and transfer. Unit of equity-oriented fund or unit of business trust on which short-term capital gain is paid on the time of transfer. Other important point, it is also provided that the aforesaid means of computation of capital gain shall be applicable in the respect of capital gain acquiring arising from every reinvestment, thereby in the sale of share or in debenture of the capital Indian company. If the total income of assessee include any income chargeable under the head capital gain arising from transfer of capital asset being an equity share in a company or unity of equity oriented funds in the business trust, a tax on a short-term capital gain shall be payable on the rates specified in section 11A if transaction of sale of such security has been entered in or after October 1st, 2024, on which SCT is chargeable, and tax on short-term capital gain shall be payable on such security as per section 112A if STT has been paid both at the time of acquisition and transfer of equity, shares or at the time of transfer of unity of equity oriented funds or unit of business trust. Long-term capital gain is payable on such a security as 112A if the SSD has been paid both at the time of acquisition or transfer of shares. Equity at the time of transfer of unit of the unity-oriented funds of visitors. Non-corporate, non-resident foreign companies to be subject to tax at the concessional rate of 10% without indexation, benefit or currency fluctuation on long-term capital gain arising from the transfer of unlisted securities and shares of company which is publicly not subsequently interested in section 112. Section 50CA provides that where consideration received or acquired on the result of transfer of capital asset, being a share of a company other than a quoted share, is less than the fair market value of such determined in such a manner as may be prescribed. Such fair market value shall be deemed to be a full value of consideration received or acquired as a result of such transfer. This provided would, however, not be applicable to any consideration received or acquiring as a result of transfer by way of class of person object to such condition as may be prescribed. Section 50D provides that in case where the consideration received or acquiring as a result of transfer of capital asset by assessee, it's not ascertainable or cannot be determined, then for the purpose of computing income chargeable to tax as capital gain, the fair market value of the asset on the date of share transfer shall be deemed to be the full value of consideration received or acquired as a result of transfer. Share and debentures, whether listed or unlisted, of Indian companies only uncommonly covers under the provision. Indian companies shall include government company. However, bond of central government, bond of state government, and bond of RBI is not covered for this purpose. Illustration. You say, hey, not resident in India remits $40,000 to India on 16th September 2006. Amount is partly utilized on 3rd October 2006, purchasing 10,000 equity shares of A Limited and the rate of 12 per share. These shares are sold at 48 per share on 30th March 2024. The fair value of share of the shares on the date of 31/2018 is 35 rupees per share. Telegraphic transfer rate of the selling and buying rate on buying coming into India, buying rate is 18, selling rate is 20, and the date of effective rate of on the date of second purchase of shares is 19 and 21, and the date of selling 15 and 16. Compute the capital gain chargeable to the assessment here. Assumption that the shares are not being sold through recognized stock exchange. Shares in purchase and sold through recognized stock exchange. So 10,000 equity shares at 12, 1,20,000. It is being sold for 10,000 into 48, 4,80,000. This is 4,80,000. So this is the share. On converting back. So when it is transferred in India, a rate of buy. You want to buy one using. You are using one selling. You are having an USD. SBI selling rate is 20 means SBI buying rate is 18. So if you have USD, you want to convert, you can buy for 18 rupees. If you want to buy USD, you want to give 20 rupees. So in this case, 18 and 61. So sale consideration is sale consideration is which has already was much solution. First question. Whether shares are not sold to recognized stock exchange or what? Sale consideration. Sale consideration 4,80,000. And what is the rate? 50 rupees, 8,000. Cost of acquisition is 20 rupees. 1,20,000, 20 rupees, 6,000 USD. So long term capital gain is 2,000 USD. Long term capital converted into USD is 2,000 into 59 buying rate is selling rate buying rate 1,80,000. Shares are purchased and sold through recognized stock exchange. Sale consideration 4,80,000, cost of acquisition 1,20,000, and the lower the fair value of consideration 1,20,000, and fair market of value 31,300. 4,80,000. Lower the fair value market authority was in full value. Indexation is not given. So 3 lakh long term capital gain is 1,30,000. Here 2,000, 1,18,000. So long term capital gain up to 1 lakh was exempted. So long term capital gain on exceeding 1 lakh is 30,000. Taxable 10% of the section 112A. To rupee denomination bond on Indian company. As a measure to enable the Indian company to raise funds from outside India, RBI has permitted them to use Indian rupee denomination bonds outside India. Accordingly, in the case of non-resident assessee, any gain arising on the account of appreciation of rupee between the date of purchase and date of redemption of a rupee denomination bond of Indian company held by him against a foreign currency in which investment is made shall not include computation of full value consideration, shall not be included below. This may be provided relief to non-resident investors who pays a risk on currency fluctuation. Fifth provision of section 48. The foreign currency which investment made shall not be included if including the computed full value consideration. Okay. Special provision respecting the chapter 12A. The 12A introduces the Income Tax Act effective June 1, 1983. Contains 7 sections: 115C, 115D, 115E, 115F, 115G, 115H, and 115I. The provision of the chapter are applicable to a non-resident man who derives investment income from a foreign currency asset or a long-term capital gain in case of respective definition: convertible foreign exchange asset, investment income, long-term capital gain, non-resident Indian and specified assets. These are to be considered. So, for definition of 115C, convertible foreign exchange. Foreign exchange, which is for a time being traded by the Reserve Bank of India as a convertible foreign exchange for the purpose of Foreign Exchange Management Act 1999 and all the rules made therefore. Foreign exchange asset, any specified asset which the assessee has acquired or purchased with or subscribed to it a convertible foreign exchange. Investment income, any income derived from the foreign exchange asset is investment income. Long-term capital gain, income chargeable under the head capital gain relating to capital asset being a foreign exchange asset which is not a short-term capital gain. Non-resident Indian, an individual being a citizen of India or a person of Indian origin who is not a resident. A person shall be deemed to be Indian origin if he or either of his parent or any of the grandparents are born in undivided India. Specified asset, any of the following assets, namely shares in Indian company, debentures issued by the Indian company which is not a private company, deposit in Indian company which is not a private company, any securities of the central government, any other asset with the central government may notify. Special provision relating to the taxation of investment income and long-term capital gain of a non-resident, section 115D to 115F. Taxation on gross basis. Section 115D deals with the computation of total income of a non-resident. In computing the investment income of a non-resident Indian, no deduction is to be allowed under the provision of the Act in respect of the expenditure or allowance thereabout. No reduction under section 115D subsection 2. No reduction under section chapter 6A shall be allowed, and indexation benefit should not be allowed where the gross total income of a non-resident Indian consists only the investment of income and other long-term capital gain. Investment non-capital resident, investment income and other investment and long-term capital gain. However, the gross total income includes investment incomes or long-term capital gains or reduction in the chapter 6A shall be allowed only on the portion of the gross total income which does not include the investment income or long-term capital gain. Tax rate of investment income and long-term capital gain. Section 115A. Under section 115A, tax payable by shall be aggregated by income tax on investment income 20%, income tax on investment income 20%, income tax on the long-term capital gain, transfer of specified assets, that is purchase of foreign currency 10%, income tax on other total income. So investment income 20% plus surcharge plus health education tax, long-term capital gain on foreign exchange asset 10% plus surcharge plus health education tax. Exemption for a long-term capital gain, section 115F. Section 115F, where a non-resident Indian has transferred long-term foreign exchange asset and has within the period of 6 months from the date of the transfer invest the whole or part of the net consideration in any of the specified assets, then if the cost of new asset is not less than the net consideration respect of the original asset, or the whole of the capital gain shall not be chargeable to tax under section 45. If the cost of new asset is less than the net consideration respect of the original asset, amount is calculated below shall not be charged to tax under section. Capital gain into cost of acquisition of new asset divided by net consideration. Percentage of what you given, that is only capital gain. Important. The net consideration means the full consideration from the transfer of not a consideration, not of net transfer less expenditure incurred wholly or exclusively connection to this transfer, not the cost. Where new asset is transferred are converted into money within the period of 3 years from the date of acquisition. The amount of capital gain arising from the transfer of original asset not chargeable to tax earlier shall deem to be the income under the capital gain relating to long-term capital assets. The same shall be charged to tax in the previous year in which a new asset is transferred or converted into money.